Have you been keeping an eye on Palantir Technology stock lately? It's been quite the roller coaster ride, with the stock showing some impressive upward momentum in recent sessions. But the trading volume has been through the roof, indicating that something big might be brewing. What's even more intriguing is the unusual options activity surrounding PLTR stock, suggesting that speculators are gearing up for some serious volatility. Buckle up because, in this video, we're diving deep into the world of Palantir stock to explore whether it's heading for explosive surges or catastrophic crashes. First, let's break down the unusual options activity in Palantir stock. Specifically, we're talking about put options here. These are contracts that give you the right to sell a stock at a certain price, known as the strike price. In this case, the strike price is $16.50, and the expiration date for these puts is September 29th, just 30 days from now. Now, why are people interested in these puts? Well, there are two sides to this story. First, you've got the long put traders. These folks are betting that Palantir stock will drop below $16.50 before September 29th. They're paying a price, in this case, $1.27 per put option, for the chance to sell the stock at $16.50. To break even, the stock needs to fall by $1.27 from its current price of $16.14, landing at $15.23. On the flip side, you've got the short put traders. They hope Palantir stock stays above $16.50 or rises in the next 30 days. By selling these puts for $1.27 each, they collect money up front. If the stock exceeds $16.50 on September 29th, they keep that upfront cash and the difference between $16.50 and its closing price. So, if the stock closes at $15.50, they still make a profit of 27 cents per share, which might not sound like much, but on an annualized basis, it's a nearly 20% return. Now, let's talk about Palantir's Q2 earnings report, which has some promising figures. First, the good news, their revenue shot up by 13% compared to the previous year, reaching a whopping $533 million. That's a significant increase. And it's not just revenue that's looking positive. Their adjusted operating income also grew by 25%, reaching $135 million. What's interesting here is that their adjusted operating income margin hit 25% of their revenue, up from 23% a year ago. That's a sign of profitability, which investors usually appreciate. But here's the real highlight: Palantir showed positive adjusted free cash flow. This means that after accounting for all their expenses, including capital spending and working capital, they had $96 million in the bank. That's a staggering 57.6% increase from the previous year. Even more impressive is that their adjusted FCF margin grew to 18% of their revenue, up from 13%. So, why does this matter? Well, when a company has positive adjusted free cash flow, it means they're no longer burning through their cash reserves. It's like having money left over after paying all the bills. This cash can be used for various things like buybacks, dividends, acquisitions, or debt payments. Moreover, Palantir's current market capitalization is worth a closer look. It stands at a hefty $34.79 billion, which sounds substantial. But what's important here is the implications of such a valuation. Now, when you peek into the future, you'll find the forward price-to-earnings multiples for 2023 and 2024. In 2023, the price-to-earnings multiple is around 67 times, and in 2024, it's about 58 times based on earnings forecasts. These multiples tell you how much investors are willing to pay for each dollar of earnings the company is expected to make. High multiples can indicate optimism, but also signal the potential for overvaluation. Let's switch gears and talk about valuation based on free cash flow. For example, if we use revenue forecasts of $2.63 billion for 2024, along with an 18% FCF margin, the free cash flow would be $473 million. Even with a more generous 20% margin, FCF would reach, at best, $526 million. Now, here's where it gets interesting. At a market cap of $34.79 billion, Palantir stock is trading for 66 times the expected FCF for 2024. To put it bluntly, this is a high valuation. In the tech world, stocks often trade for no more than a 3% or 3.33% FCF yield. So, by these standards, Palantir stock might be up to 50% overvalued if it were to drop from 66 times FCF to 33 times FCF. In simpler terms, the stock could be significantly pricier than it should be according to industry norms. However, there are concerns about the potential overvaluation of Palantir stock when you look at the current valuation metrics. Given its market capitalization of $34.79 billion, this could be a bit on the high side. Now, let's think about what could happen if the stock was overvalued by 50%. This would mean that the stock's true value might be significantly lower than what investors are currently willing to pay for it. If it were to fall from its current valuation to a more reasonable level, it could experience a substantial price correction. In practical terms, this could lead to a sharp decline in the stock's price, resulting in losses for investors who bought in at a higher valuation. Furthermore, there's a broader risk associated with high valuations in the technology sector. When stocks become overvalued, they can be more vulnerable to market fluctuations and economic downturns. Investors may start to question whether these companies can live up to the high expectations built into their stock prices. This can lead to increased volatility and the potential for larger price swings. But before we continue, we want to thank you for watching this far. An IBD Smart Select composite rating was also released for Palantir Technologies, giving you a glimpse of how it's performing compared to other stocks. This rating for Palantir stands at 96, just 1 point shy of a top-notch 97. In simple terms, this suggests that Palantir is outperforming a significant chunk of the stocks when considering various performance metrics. Now, let's talk about the stock's technical strength, which is an essential factor for investors. Palantir has been showing some muscle lately, and it's worth noting that it recently experienced a breakout. When we say breakout, we mean it managed to break through a significant price level, signaling potential upward momentum. This could catch the attention of traders and investors looking for opportunities in the market. Another important aspect to consider is Palantir's accumulation/distribution rating, which can provide valuable insights for investors like you. This rating, currently at a modest D-, signifies that there has been moderate selling activity by institutional investors over the past 13 weeks. Institutional investors, such as big investment funds, can significantly impact a stock's price and performance. Buying or selling in large volumes can sway the market sentiment and affect a stock's trajectory. In this case, the moderate selling suggests that some institutional players have been reducing their positions in Palantir. Furthermore, it's important to recognize differing opinions among analysts and investors when it comes to Palantir stock. Some experts see it as a potential winner, while others are more cautious. This diversity of viewpoints often reflects the uncertainty and complexity of the stock market. Taking a look back at Palantir's journey since its IPO in September 2020, you'll notice a rather turbulent ride. It burst onto the scene, with its stock soaring from an initial $10 per share to a high of $39 in January 2021, driven partly by meme and growth stock mania. However, since then, it's experienced ups and downs, with its stock now hovering around $14, even though it more than doubled in value this year. The impact of AI-related hype should also not be underestimated. The rise in interest and investments in artificial intelligence has led to a surge in AI-related stocks. Being involved in AI and big data solutions, Palantir fits right into this narrative. Investor expectations can sometimes run high due to the AI buzz, which can contribute to stock price fluctuations. As Palantir's story unfolds, it's clear that there are both potential upsides and downsides for its stock. On one hand, the company has shown growth in revenue and profitability, and its involvement in AI and big data solutions aligns with industry trends. However, there are concerns about its valuation and the risk associated with high expectations. Before investing in this stock, it's crucial for you to do your own research and consider the risks involved. Assess whether the current valuation aligns with your investment goals and risk tolerance. Remember that the stock market can be unpredictable, and past performance does not always indicate future results. So, as you ponder the future of Palantir Technologies and its stock, ask yourself, is the potential reward worth the risk? How does this investment fit into your overall portfolio strategy? Let us know in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about Palantir stock, I highly recommend watching this fantastic video. Just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.